So you want to own a casino. You've probably already built the picture in your head. Slot machines humming into the early morning. A blackjack table full of tourists slowly losing their vacation budget. Maybe a high roller in the corner, up a few $100,000, sipping something expensive while a pit boss watches him like a hawk. You've heard the phrase 1,000 times. The house always wins. Small edge, huge volume, guaranteed profit. And sure, that's true. But if you think that's the actual business of owning a casino, you've been sold half the story. Because here's the uncomfortable truth. The biggest, most profitable casino companies in the world today might not even own the building you're gambling in. They might not be the ones lending you money to keep playing. And the person managing your debt when you lose might not work for the casino at all. Owning a casino today isn't really about the odds on the table. It's about real estate, credit, and control. So let's actually open the books, because where the money goes is a lot stranger than you think. Let's start with the single fact that breaks the whole fantasy. When you picture who owns Caesar's Palace, you picture Caesar's. Big logo, big lights, big company. Makes sense, right? Except Caesar's doesn't actually own that building anymore. Neither does MGM own most of its own casinos on the Strip. Somewhere around the mid-2010s, one by one, the biggest casino operators in America sold off their real estate, the land, the towers, the parking structures, all of it, to a completely different kind of company. Not a gaming company. A landlord. These are called gaming REITs, real estate investment trusts that specialize in casino properties. The biggest one is called Vici Properties, and if you've stayed at Caesar's Palace, the Venetian, or a dozen other iconic Vegas resorts, you've technically been a guest in a building Vici owns, not the casino brand on the sign. Here's how the deal works. Vici buys the physical property, then leases it back to the operator, Caesars, MGM, whoever, on what's called a triple net lease. That means the operator, the tenant, is on the hook for basically everything. Property taxes, insurance, maintenance, renovations, all of it. Vici just collects rent. Predictable, contractual, almost boring rent. For terms that stretch 20, 30 years into the future, often with built-in rent increases baked into the contract so it keeps pace with inflation. Think about what that actually means. The company whose name is on the building is renting it. The company you've never heard of, the one that shows up on nobody's marketing, has no slot machines, no dealers, no comp drinks, is the one that arguably has the safer, cleaner cash flow. Vici doesn't care if it's a slow Tuesday on the casino floor. It doesn't care if a high roller has a great night and the casino loses money. The rent check is due either way. So if you're asking, where does the real profit sit in the modern casino industry, part of the honest answer is, increasingly, it sits with the landlord, not the house. Now here's where it gets even more interesting, because this split between real estate and operations wasn't some genius long-term strategy dreamed up in a boardroom. It was born out of desperation. Vici exists because of a bankruptcy. In 2017, Caesars Entertainment's operating company went through Chapter 11, and Vici was created specifically to separate the real estate from the operating business, a maneuver designed to maximize what creditors could recover, using the tax advantages that come with being structured as a REIT. The landlord-tenant split that now defines how billions of dollars move through the casino industry exists because Caesars went broke and its creditors needed a clean way to get their money out. And if you want to go even further back, the reason casinos were ever tied this tightly to their buildings in the first place is its own strange story. In the 1960s and 70s, when Ray Kroc was building McDonald's and Sam Walton was building Walmart, they had easy access to normal bank financing. Casino operators didn't have that luxury, because at the time, gambling was still considered sin business, and mainstream banks wanted nothing to do with it. So the man who built Caesar's Palace, Jay Sarno, had to borrow from sources like the Teamsters Union Pension Fund instead, financing that came bundled with the same murky, high-risk baggage you'd expect from that era of Vegas history. That single financing gap 60 years ago, banks won't touch it, so find money wherever you can, is the direct ancestor of the ultra-engineered real estate structures running Vegas today. The industry spent decades trying to legitimize itself financially, and the REIT model is basically the final form of that effort, strip the risky, gambling operation away from the safe real estate asset and sell investors on the safe part. So before you even think about what happens on the casino floor, understand this. Modern casino ownership has quietly split into two completely different businesses wearing one building. One collects rent like a landlord. The other absorbs all the risk of the game. And increasingly, it's not the name on the sign that's making the safest money. Okay, now let's talk about what actually happens on the casino floor. Because there's a second hidden business running underneath the gambling, and it's one almost nobody outside of Vegas understands. Casinos are, quietly, one of the most aggressive lenders in the country. You've probably heard of high rollers and whales, players who bet big. But here's what's less known. A huge amount of that big betting isn't happening with cash. It's happening on credit, extended directly by the casino itself, completely interest-free. It's called a marker. If you're a player with a solid bank account or a track record with the casino, you can sign a slip, essentially a promise to pay, and instantly get chips. No interest. No monthly payment plan. Just a flexible IOU between you and the house. On the surface, it sounds almost generous. In practice, it's one of the most calculated pieces of marketing in the entire gambling industry, because a player gambling with borrowed chips behaves completely differently than a player gambling with cash sitting in front of them. The pain of losing feels smaller. The willingness to keep playing goes up. The casino isn't just extending credit, it's extending your night. But here's the part that should genuinely shock you. In Nevada, if you don't pay that marker back, usually within about 30 days, you're not just facing an awkward phone call. You're facing a felony charge. Nevada law treats an unpaid marker exactly like writing a bad check. And this is where it gets almost unbelievable. The Las Vegas District Attorney's Office runs an entire dedicated division called the Bad Check Unit, whose job is chasing down unpaid casino debt on behalf of the casinos. And that office doesn't do it out of civic duty. It gets paid. Successful collections can earn the DA's office up to a 10% reward. So if a gambler owes $20,000 and the Bad Check Unit collects it, that gambler now owes $22,000, with $2,000 of that going straight into funding the very government office that came after them. Sit with that for a second. A private, for-profit casino's unpaid debt is being enforced, in part, by a public prosecutor's office that takes a cut of the recovery. That's not how any other consumer lending business on earth works. If you don't pay your furniture store financing plan, nobody's threatening you with a felony and a state prosecutor doesn't get a commission. But gambling debt in Nevada operates in its own legal universe. And the scale of this lending is enormous. In Atlantic City alone, in a single year, casinos issued over $2 billion in markers to gamblers. $2 billion of essentially unsecured, interest-free credit handed out across 12 casinos. Most of it gets paid back, but not all of it. Casinos routinely write off around 5% of their marker debt as simply uncollectible, sometimes totaling millions of dollars a year at a single property. That's not a rounding error. That's a built-in cost of doing business, baked quietly into the model, the same way a bank prices in loan defaults. So when you ask, how does a casino actually make money, part of the honest answer is, it's not just running games with a mathematical edge. It's running an internal, unregulated feeling consumer lending operation, issuing billions in credit, enforcing repayment with the threat of criminal prosecution, and absorbing the losses when it inevitably doesn't come back. And if you want to understand exactly how far this credit system can spiral, there's one story that the entire casino industry still talks about. In 2007, a businessman from Omaha named Terrence Watanabe became one of the biggest gamblers in Las Vegas history. Over the course of that single year, he lost close to $127 million, almost entirely at Caesar's Palace and the Rio. He actually paid back the majority of it, $112 million. But nearly $15 million remained outstanding on unpaid markers, and he refused to make good on it. What makes this story so wild isn't just the number, it's what came out afterward. There were accusations that casino hosts kept him drinking and playing well past the point of good judgment, allegations that management at other properties had actually barred him for compulsive drinking and gambling before this happened. In other words, The same system built to extend easy credit to high-value players may have actively kept one of its biggest whales in the game long after he should have walked away. Eventually, Watanabe settled the debt for an undisclosed amount, and the district attorney's office collected $500,000 directly from him for their trouble. Here's why this story matters for understanding casino economics, not just as gossip. It proves that the credit machine isn't risk-free for the house either. Casinos don't just profit off small mathematical edges repeated millions of times. They also make enormous, concentrated bets on individual whales, extending massive lines of credit to a handful of players, betting that the house edge and the psychology of play will win out over time. Most of the time it does. But when it doesn't, when a single player loses that much and then fights the debt, that's when you see just how much of the house always wins actually depends on collections working, lawyers getting involved, and a legal system built specifically to back the casino up. Now, if American casinos built an entire legal and financial system around chasing down player debt, you might assume that's just how it works everywhere. It's not even close, and nowhere proves that more than Macau. Macau isn't just another gambling city. For decades it was the biggest gambling market on the planet, dwarfing Las Vegas in total revenue. But the way it made that money looked completely different, because of a business most Western gamblers have never heard of, the junket. A junket operator is essentially a private, outsourced high-roller recruiter. They find VIP players, often wealthy players from mainland China, organize their entire trip, and in the traditional model, they extended the credit lines themselves and handled debt collection themselves, often relying on informal, sometimes coercive methods back in mainland China, operating almost entirely outside the formal banking system. In exchange, junket operators earned a commission based on the total amount their players wagered, their rolling chip turnover. And at their absolute peak, these junket-driven VIP players weren't a side revenue stream. They accounted for somewhere between 70 and 80% of all of Macau's gaming revenue. Let that sink in. For years, the majority of the money moving through the biggest gambling market on Earth wasn't generated by the casino's own marketing or credit systems at all. It was generated by third-party operators who essentially ran a private, offshore, high-stakes lending business on the casino's behalf and took a cut for doing it. Casinos loved this model because it outsourced their highest-risk, highest-reward customers to somebody else. The junket took on the headache of finding whales, fronting them money, and chasing them down if they didn't pay, the exact same headache that gets American casinos tangled up with bad check units and felony prosecutions. The casino just collected its share of the turnover and stayed clean. But that entire system got dismantled almost overnight. Concerns over money laundering and illegal capital flight led to a massive regulatory crackdown, and since a 2022 overhaul, junket operators in Macau are now completely prohibited from extending credit to players at all. Only licensed casino concessionaires, the casinos themselves, are allowed to offer credit lines now. Junkets that still operate are capped at a small fixed commission, a maximum of just over 1% of net rolling turnover, instead of sharing meaningfully in casino revenue the way they used to. In just a few years, one of the largest informal lending and revenue-generating systems in global gambling got legislated almost out of existence. If you're thinking about casino economics as an investor, this is maybe the most important lesson in the entire video. A huge percentage of guaranteed gambling revenue can evaporate the moment a government decides the underlying financial structure is too risky to allow. And it's not just Macau that treats this differently. Go to the United Kingdom, and the entire American credit marker model is essentially illegal. Under UK gambling law, land-based casino operators are expressly prohibited from extending any credit for wagering whatsoever, no markers, no credit lines, nothing. Even online, remote operators are banned from accepting credit card payments for betting. It's a deliberate policy choice, built specifically to prevent people from gambling with money they don't actually have. So depending on which country you're standing in, the entire underlying business model of owning a casino changes completely. In Nevada, credit is the engine, backed up by criminal law. In Macau, credit used to run almost entirely through private outsourced operators, until the government shut that down. In the UK, credit for gambling barely exists at all. Same industry, Three completely different financial machines. So, where does the money actually go when you own a casino? Some of it goes to a landlord you've never heard of, collecting rent on a building with the casino's name on the front door. Some of it gets lent out, interest-free, to players who might behave completely differently with borrowed chips than they would with their own cash, backed by a legal system willing to prosecute unpaid debt as a felony. Some of it gets outsourced entirely to private operators halfway around the world, who take on the risk of finding and financing your biggest players in exchange for a slice of the action, at least until a government decides that arrangement is too dangerous to allow. The house edge is real. The math never lies. But the math was never the whole business. Owning a casino today means owning a real estate portfolio, running a shadow lending operation, and betting on regulation not changing underneath you, sometimes all three, in the same building on the same night. And that's the version of, the house always wins, nobody puts in the brochure.